Welcome back to the channel. In this video, I'm going to show you how to use owner financing to buy your dream home in a high interest rate market. Buying a home is one of the biggest financial decisions you'll ever make, but it can also be one of the most challenging. With interest rates rising and mortgage lenders tightening their criteria, you may find it hard to qualify for a loan or afford the monthly payments. But what if there was another way to finance your dream home without the bank fees or relying on a bank or a mortgage company? What if you could pay the seller directly and avoid the hassle and cost of a traditional loan? That's where owner financing comes in. Owner financing, also known as a seller financing deal, is a real estate agreement in which the seller of the property finances the purchase for the buyer. Instead of getting a mortgage from a lender, you make payments to the seller until you pay off the purchase price. Owner financing can be a great option for buyers who don't qualify for a conventional mortgage from a traditional mortgage lender or who want to save money and time in the home buying process. It can also benefit sellers who want to sell their homes faster, earn more income from interests, and defer taxes on their capital gains. Before we dive in, it would be most appreciated if you could like this video and subscribe to our channel. Thanks in advance, and thank you to unlockedfi.com for sponsoring this video. Step-by-step link is down in the description. How owner financing works. Owner financing is similar to a conventional mortgage loan, except the seller acts as the lender. The buyer and the seller agree on the terms of the loan, such as the purchase price, the down payment, the interest rate, the repayment schedule, the consequences of default. The buyer signs a promissory note to the seller that spells out these terms and promises to pay back the loan. The seller may also require a security instrument, such as a mortgage or a deed of trust, that gives them the right to foreclose on the property if the buyer fails to pay. The buyer usually makes monthly payments of principal and interest to the seller, just like they would with a regular mortgage. However, most owner financing deals are short-term loans with low monthly payments and a large lump sum payment due at the end of the term. This is called a balloon payment. The balloon payment is typically due after 5 or 10 years, depending on the agreement. By then, the buyer is expected to have enough equity in the home or enough time to improve their credit score to qualify for a refinance. The buyer can then use a conventional mortgage to pay off the seller and own the home free and clear. The seller may or may not transfer the title to the buyer at the beginning of the loan. Some sellers prefer to keep the title until the buyer pays off the loan in full. This is called holding legal title. Others may transfer the title to the buyer right away, due on sale clause, and retain only a lien on the property. This is called holding equitable title. How to structure an owner financing deal. If you decide that owner financing is right for you, either as a buyer or a seller, here are some steps that will help you structure an owner financing deal that works for both parties. Negotiate the terms of the loan. The first step is to negotiate with each other on how much down payment will be required, usually 10 to 15%, what interest rate will be charged, usually higher than market rates, what repayment schedule will be followed, usually monthly, and what balloon payment will be due at the end of the term, usually after 5 or 10 years. Draft a sales contract and a promissory note. The second step is to draft a sales contract that outlines the details of the purchase, such as the property description, the property price, the down payment, the closing costs, and any contingencies. The sales contract should also include a clause that states that the seller is providing owner financing to the buyer and that the terms of the loan will be specified in a separate promissory note. The promissory note is a legal document that records the loan agreement between the buyer and the seller. It should include the loan amount, the interest rate, the repayment schedule, the balloon payment, the late fees, and the default remedies. The promissory note should also state whether the seller is holding legal title or equitable title to the property until the loan is paid off. Record the security instrument. The third step is to record a security instrument that gives the buyer and seller both a lien on the property in case the buyer defaults on their payments. The security instrument can be either a mortgage or a deed of trust, depending on the state laws and preferences of the parties. A mortgage is a document that pledges the property as collateral for the loan and allows the seller to foreclose on it if the buyer fails to pay. A deed of trust is a document that transfers the title of the property to a third-party trustee who holds it until the loan is paid off. If the buyer defaults, the trustee can sell the property on behalf of the seller. The security instrument should be recorded within the county recorder's office where the property is located to make it public and enforceable. Make and receive payments. The fourth step is to make and receive payments according to the terms of the promissory note. The buyer should make timely payments to the seller every month and keep track of their balance and interest. The seller should provide receipts to the buyer, make monthly payments, and report their interest income to the IRS. Pay off or refinance the loan. The fifth and final step is to pay off or refinance the loan. The buyer can either make the balloon payment in full or refinance the loan with a conventional mortgage lender and use the proceeds to pay off the seller. The seller can then release the lien on the property and transfer the title to the buyer if they haven't done so already. Tips for owner financing. Owner financing can be a complex and risky transaction for both buyers and sellers, so it's important to do your homework and follow some best practices before entering into an owner financing agreement. Here are some tips for owner financing that can help you avoid common pitfalls, secure financing, and protect your interests. Hire a real estate attorney. Owner financing involves legal documents and contracts that can have serious consequences if not drafted properly. It's advisable to hire a qualified real estate attorney who can help you review, negotiate, and finalize the terms of the deal. An attorney can also help you comply with state laws and regulations that govern owner financing transactions. Do your due diligence. Both buyers and sellers should do their due diligence before agreeing to owner financing. Buyers should check the seller's credit history, property ownership, title status, liens, taxes, insurance, and any other relevant information that may affect their purchase. Sellers should check the buyer's credit history, income, employment, debt, and any other factors that may affect their ability to repay the loan. Get an appraisal and an inspection. Even though owner financing doesn't require an appraisal or an inspection, it's still a good idea to get them done for your own peace of mind. An appraisal can help you determine the fair market value of the property and avoid overpaying or undercharging. An inspection can help you identify any defects or issues with the property that may need repair or improvement. Use an escrow service. An escrow service is a third-party company that acts as a neutral intermediary between the buyer and the seller. The escrow service can collect and distribute payments, hold documents and funds, and handle any disputes that may arise during the transaction. Using an escrow service can help you ensure that everything goes smoothly and securely. Consider seller financing alternatives. If an owner financing agreement is not feasible or desirable for you as a buyer or a seller, you may want to explore other options that can help you achieve your goals. For example, you may consider rent-to-own agreements, lease options, land contracts, or assumable mortgages as alternatives to some owner financing agreements. Owner financing is a real estate financing method that can offer benefits for both buyers and sellers who are looking for more flexibility and control over their home purchase or sale. However, owner financing also comes with risks and challenges that require careful planning and preparation. If you're interested in owner financing, make sure you understand how it works, what are the pros and cons of owner financing work for both parties, and how to structure an owner financing deal that works for both parties. You should also consult a real estate attorney who can help you draft and review the legal documents and contracts involved. Owner financing can be a great way to buy or sell your dream home in a high interest rate market, but only if you do it right. A special thank you to UnlockedFi.com for helping us bring you this valuable content. If you're looking to take the first step toward achieving financial freedom, be sure to visit UnlockedFi.com and download their free Unlocking Financial Freedom ebook. The ebook provides valuable tips and strategies for achieving financial success and is available for download for free by clicking the link in the description below. Thank you to UnlockedFi.com for sponsoring this video and providing valuable resources to help you on your journey to financial freedom. And that's it. I hope you found this video helpful and informative. If you did, please give it a thumbs up and subscribe to the channel for more videos like this one. Thanks for watching.